Yeah, Cam, hold on one second. I want to. Okay, we are now recording. So, good afternoon, everybody, and thank you for joining us for our year-end cap for our Stoneridge speaker series. It's been one heck of a year, to say the least. We've had a pandemic. We've had a payment change in home health. We've had an election, a presidential election that's been very unique, to say the least. And so there's been all kinds of craziness going on in the world, and there's been a little craziness in our industries as well. And Stoneridge welcomes the opportunity and thanks you all for joining us to discuss it. Today we have two of my esteemed partners and also another colleague, esteemed colleague, Bob Holly, to join us from Home Health News to discuss what's going on in the M&A world and what's going on in home health, hospice, and in behavioral health. So our format, as normal, is a fireside chat. You guys have the ability to send questions in as we go, and I will address them either as we go or at the end. My promise is this will be no more than 60 minutes. We typically keep it between 45 and 60 minutes. Each of our participants, Brian, Ben, and Bob, the three Bs today. I will screw this up for sure. The three of them will get the opportunity to open up with some brief intro of themselves and 5 minutes or so of intro and brief comments about what they see in the market. I have some prepared questions and open up for a fireside chat. We'll have a discussion. Obviously, you guys send in questions as we go, and we'll keep some time to answer those that don't flow through the natural conversation. So once again, welcome everybody. We are very excited here and we're looking forward to a good year. Stoneridge has had actually, it didn't look that way in Q2, but Q3 and Q4 have been a really good, strong year. We look to finish off the year very, very well. It's been a remarkable year from us from a deal perspective. Crazy to say the least, but and we're excited about 2021. So we're going to start with my partner and friend, Ben Bogan, who hails from Arizona. And with that, Ben, I'll turn it over to you to introduce yourself and give us some words of wisdom on what's going on.
Great. Thanks, Rich. I really appreciate that. As Rich said, I am a partner and executive vice president with Stoneridge, and I'm in a fortunate position to say that I'm a recovering attorney. I've been running home health, home care, and hospice transactions since 2014, and I've had the ability to watch the market evolve since that time. Currently, as most of you are aware, we've seen strong demand for hospice assets, which has resulted in some mind-blowing valuations, which we can discuss more fully a little later. What is particularly notable to me, perhaps right now, is just the sheer number of deals that have been announced recently. It seems like every day you wake up, another deal is being reported, which raises the question, why? My unconfirmed guess is at the end of what I'll kind of call the COVID pause earlier in the year, caused by delays in deals, that has resulted in many of them lining up now for the fourth quarter. As Rich said, earlier in the year when COVID first kind of raised its ugly head, seemed like the market was basically coming to a complete standstill, with most of the buyers that are typically out there kind of going on pause for, I think, a couple of reasons. One, to focus on their current operations for those strategics, and then also to kind of wrap their head around just what COVID meant and what this was going to mean in the long term. Just recently, we've seen the Accent Care Seasons merger announcement and the Addus acquisition of Queen City Hospice. But my guess is this is not the end. April Anthony recently seemed to suggest that we should be hearing some fourth quarter or first quarter 2021 announcements coming from Encompass. Most of the recent announcements are deals of significant size, but as these notable players continue to exercise what is their well-publicized strategy, that being offering the full continuum of care or getting all the legs of the three-legged stool. Smaller deals are getting done too. For example, we had the LHC's recent announcement of their smaller hospice acquisition in Arizona, East Valley Hospice, where they already had a home health footprint. These buyers, although notable because of their size, obviously only represent a fraction of the buyers actually out there. There are smaller, more regional strategics that are very active, and we've been inundated with interest from financial buyers. Because many of the deals that these buyers close go unreported, it's hard to know for sure the true number of deals that are actually closing. But what is clear right now is the market is very robust with strong interest and high valuations, at least for the right assets in the right markets with the right buyers engaged. And with that, I think I'll kind of end my intro, hand it back to Rich to maybe pass off to one of my colleagues at this point.
Sure. Thanks, Ben. With that, let's go to Bob. Let's go to Bob and see what's going on in home health news and what's going on in your world, Bob.
Sure. Well, thanks, Rich. And, first of all, thanks for asking me to participate in this. Really enjoy hearing what you guys have to say on the M&A front. Stoneridge is one of our go-to sources for stories. So thanks for all that you guys do for us as well. If the people tuning in don't already know me, I'm HHCN editor Bob Holly. Home Healthcare News is part of the Aging Media Network umbrella. Our other publications include Skilled Nursing News, Senior Housing News, Hospice News, Behavioral Health Business, and Reverse Mortgage Daily. COVID has really been topic 1, 2, and 3 across our verticals, especially Skilled Nursing News, as you can imagine. Alex Benko and Maggie Flynn have been doing incredible work covering that space for a while. I started covering the home health, hospice, home care industries back in 2018. Before that, covered the agribusiness sector. And one of the key themes back then for me was covering all this consolidation that we were seeing in agribusiness. And it seems like that kind of followed me into home health and hospice and home care with all the consolidation that we're seeing and that we'll likely continue to see next year. In terms of Aging Media Networks verticals, I'd say Home Healthcare News is probably our largest and fastest growing vertical, which I think reflects what we're seeing in healthcare. People want to shift care into the home. It's often the safest. It's often the most cost effective. And in addition to that background, I'll just say my general mission for our newsroom is to make our coverage essential to our readers. We want to make sure that we're covering topics that are vital to running a home care or home health business. Ben, everything that you said, I would kind of echo. I think Addis during its Q3 call talked about how that pause on M&A really is over and how they're revving that M&A engine again. Again, partly to build density in their key areas like Ohio. It's definitely been a much busier last several weeks compared to the early part of this year. And we're looking forward to what 2021 holds. It's definitely a breath of fresh air for us when the news isn't just COVID, but sometimes we get to cover these really exciting deals.
Okay. Thanks, Bob. And before I turn it over to Brian, I laughed, Ben, when you said you were a recovering attorney, because you probably stole that from Brian, who's going to speak next, or myself. But with that, I'll turn that over to my friend and partner, Brian Bruenderman.
Thanks for stealing my line, Ben. I am also a recovering attorney, and Brian Bruenderman, I'm also a partner in Stoneridge. It's not the first line Ben's stolen from me, don't worry. So. I've been in the home care and hospice space for a better part of my career. First as a buyer for large corporate entities, and then most recently with Stoneridge for a better part of a decade. So I see a lot of familiar names on the participant list. Thank you guys for joining me. Unfortunately, I kind of look forward to this as sort of an opportunity as the holidays approach to do a 2020 recap, and had hoped that it was, in case you tuned into our knock session, I would hope we'd have drastically different news. Unfortunately, amidst a recent COVID spike, I'm afraid it's kind of the same. So you may hear some of the same things that we said a few months ago. But the I think we're all as deals slowed down in 2020. I think we all looked forward to a somewhat robust second half of the year. It hasn't happened, but I think as you know, and I think the question mark in a lot of people's minds is, will this recent COVID spike and some of the uncertainty around post-election results, will that cause a longer pause in M&A activity? Again, I think I'll echo what Bob said. Is what I'm hearing from buyers is, hey, we're ready to get back in this game and really go full tilt. What I have seen is certain sectors have remained relatively robust, particularly Medicaid personal care. While I think we all expected Medicare home health to slow down, given that March sort of meant the full when agencies felt the full effect of PDGM and then got slapped with COVID. I think they just had a lot of stuff to deal with managing their own operations, and I think that the idea of going to market sort of wasn't really top of mind. As a result, and I've heard several M&A experts quoted, Bob, in some of your articles about there's just they can't remember a time when demand has been higher, and I'd argue it's just a direct response to lack of supply, as many providers sort of sat on the sideline dealing with COVID, and particularly in the Medicare home health space. So Medicaid personal care has remained relatively robust. Obviously, hospice is a hot sector, has been alluded to. I have to be honest with you, I'm a little surprised given the amount of large transactions in the hospice space in 2019. I'm surprised that there are that many large independent hospice providers left. But I think, Ben, you captured it, that, hey, look, there's, it's not just the large providers that are transacting anymore. Everybody's looking to sort of fill out those three components of their footprint. So I think one of the things that I would want to talk about as we go through the process today is maybe some of the subsectors that haven't received as much attention. I'll point specifically to other Medicaid-funded services, IDDD behavioral health and pediatric. Medicaid-funded pediatrics have remained relatively hot all the way through COVID, and unsurprised, and actually surprisingly, we've seen a really increased interest in private pay home health. With transactions happening or at least under contract at historically high valuations. So I think that's there's some meaningful insight to be gained from that, as well as people sort of gather resources to help keep people at home and out of facilities. So I'll just turn it back over to you, Rich, and see what I think we've got a number of things we want to talk about. So
thanks, Brian. So for those who don't know me, I'm Rich Tinsley, a partner here with Stoneridge Partners, and get the pleasure of working with Ben and Brian every day. And as you guys can tell, it has been a very challenging time period, and we do have a very asymmetrical demand curve when it comes to supply of businesses for sale. And it's also very specific on the types of businesses. Hospice has remained strong even through COVID. But the deal flow obviously slowed up in Q2 just for lack of travel and other logistics, and that has picked back up. But to Brian's point, the what I would call the meat and potatoes home care companies that were the bread and butter of transactions, that is still not probably bounced back to 100% in Q3 and Q4 the where it was in 19. So we'll dive into this more, but so Bob, let's start with you with some questions and let's make this an interesting conversation. So today is November 18th. Obviously COVID, the numbers are going back up. Where do you see us sitting today? What do you think providers are saying? I know you talk to providers every day, but what's your take on what's going on and where's everybody's sentiment on COVID-19 and what we're seeing?
Yeah, so I think we really started to see this third spike starting at the beginning of October. Back then, I reached out to a lot of home health providers just trying to see what they were seeing, what they were feeling. And the answer was kind of business as usual, at least in the COVID world. They weren't seeing any a huge influx in COVID patients. They weren't seeing those volume swings that we saw in spring. But that's changed a little bit. Within the last 2 weeks, a lot of the providers we're connecting with, they are seeing a sudden increase in COVID patients, and staffing has particularly been a huge challenge. Both having enough staff to care for existing patients, but also as community spread rises, these clinicians and caregivers could become exposed, and they have to be quarantined, go through that 2-week process before they could go back to delivering care in the home. So that's been a really, really difficult challenge right now. The positive thing, the positive theme that we're hearing is nobody's really caught off guard. In spring, home health, hospice, and home care volumes plummeted. Patients were declining visits, and across the board, agencies said that they didn't have the PPE that they needed, and it was really difficult to find. They maybe didn't have the protocols in place. They didn't know when to bring staff back. But it seems now everybody really knows what to expect. They have their ducks in a row. Again, the main challenge really has just still been staffing. The last important thing I'll note, Rich, before turning it back over to you, is I just read this morning that in 8 states, 35% of hospitals were at capacity and facing severe staffing shortages, both because of COVID and because of staff exposure. This has led to a huge demand for home health and home care services to help decant those hospitals and bring patients into the home. It's been a trend over the past 8 to 9 months, but we're seeing a huge demand for that right now. When we were reporting on the Accent Care Seasons merger on Monday, Accent Care's CEO Steve Rogers, for example, said that one of their health system partners was calling him on the phone saying, "Hey, we need help. We need to get our patients back into the home." So that's the one positive too. It's a very, very difficult time, and it's probably going to remain difficult headed into the winter, paired with the flu too. But the demand for home-based care has never been higher.
Okay. Just as an add-on to that, Bob, I think you're absolutely right. One thing that I have seen, that I've noticed, and I think you probably have seen the same thing, is that in certain sectors, I've seen that what you're talking about really lead to a growth in availability of staff for home care providers. Because oftentimes it's a lot of those folks would rather be in. Frequently, it's one person in one home for some finite period of time. And that's a little more of a controlled environment than working in a facility. And so I think that's, top that with record unemployment, particularly on the Medicaid personal care and private pay home care side, there's an availability of staff that we haven't seen for a while. Now, how to operationalize, the savvy operators have figured out how to operationalize that, right? They've got to get PPE, they've got to maintain safety protocols, they've got to keep their staff and patients safe. But we've actually seen providers grow through this pandemic as a result of exactly what you're talking about. I'm not sure that there's a strong preference for working in a hospital facility right now, right? I mean,
yeah, and this has got to be one of the few spaces that actually is seeing growth. How many other sectors could say that they're growing during a pandemic?
Right.
Ben, let's shift back to you, and you can comment on that too if you want. But the question I'll throw out to you to incorporate is the current state of M&A and home health hospice, and then kind of wrap up your thoughts on the COVID pause that you brought up in your opening comments.
Yeah, so, I guess, my impression, I think, is a little bit different from what I heard Brian represent when he did his intro. And I think one area that I do agree, maybe we are seeing so many deals and it feels so robust because of the pause, and that we do have a lack of supply right now. Demand is high, supply is low. So obviously you're going to have a very, very active market. It does seem, and I will agree with Brian, that it does seem that a number of the individuals that might be contemplating a sale right now are focused on other things. Obviously trying to get through the issues related to COVID. But I feel like as the year has progressed, we're seeing more parties begin to reach out and to begin to contemplate going to market and having those types of conversations with buyers. And as far as the M&A process, I mean, I think something that Bob touched upon, which is that providers aren't getting caught off guard right now. I think it's the same with the M&A transaction world as well. Buyers have now been through this process. They've learned how to deal with it instead of doing on-site meetings or doing Zoom meetings, et cetera. So I think everybody's kind of learned through the year how to make these transactions work, how to move them forward. Might take a little bit longer than they had in the past, but deals are getting done. And I don't think that you could argue that there is very, very high interest and high demand from buyers. But what I would say is that, not all target looks the same. I mean, there are some caveats, things like geography. Are you in a CON state or not? Size, what kind of management team do you have? How did they handle the COVID process? What does their business look like over the last couple of years? Are they growing? Are they stagnant? Are they declining? And then probably the most important thing in any transaction is who are the buyers that show up on any particular day? So let me kind of stop there. I don't know if you have a follow-up question, if I got lost in my train of thought there. Or...
No, that's fine. Any comments, Brian or Bob, before we move on to the next topic, which is in line with this?
No.
Go ahead, Bob. I'm sorry.
Sorry, I was just going to say no, Ben, I would probably agree with that because I know on top of all the remote doing deals virtually kind of thing, people are also figuring out what does a deal look like when there's PPP money involved, and maybe people have a better sense of how those logistics actually work now compared to 2 months ago.
Well, and we have better guidance for that now, right? We actually have some guidance and some mechanics on how to manage that. We have some guidance, whereas we had none. So I'm not saying it's better. I'm just saying there is some. So yeah, we've dealt with that. Actually, I see a couple of people on this call that we've dealt with it directly on, so in specific transactions. But I do agree with you. I think, Rich, one of the things that you mentioned was the asymmetrical approach. We have a lot of buyers who are entering the space. I think there's a very widespread realization that PDGM didn't make Medicare home health a bad business, right? It's a different business. It's not a bad business. It's just, and so we've got a ton of increased interest. It's just, and I don't think that the bounce back that experts are expecting for the first quarter, given this recent spike, is quite as robust. But that lack of supply has driven valuations. We were already at historical highs, right? And because of the scarcity of really quality assets, I think that's pushed them even higher. And I think that if you are a provider thinking about or contemplating a sale, I'm not sure it's not a bad idea to get your house in order and think about entering the market prior to if this pent up demand and supply just flooding the market when people finally get this stuff together and realize, hey, you know what, we've got this. To Bob's point, if we figured out this once, we can figure it out again. We'll get through it. It's fine, right? So I'm not so sure. There may be some benefit from a valuation perspective to approaching the market sooner rather than later, given the amount of buyers and the lack of supply. So.
Well, so
these are different buyers, right? Rich, I think that something you and I've talked about. There are a lot of folks who haven't been in the industry yet.
Yeah, so we talked about, I think we mentioned it the last time we had on the speaker series. I used to get 1 or 2 calls a week of new buyers, right? I got a private equity. We've raised a new fund. We like this space. I get 3 a day now. And I'm sure, Ben, you're getting them, and Brian, you're getting them. It's almost at a point where I can't talk to them all because it's all I would do all day long. So now our job is to talk to them and find out who they are and how good they are and what they can do. But the amount of new buyers in this space are unbelievable. And it's because PDGM is not bad. PDGM is just a little bit different than what it was before. And I think it's going to be a great business. It's just different than what the therapy-driven model was prior to this year. But I think what you're hearing, and the differences between some of Ben's comments and Brian's and Bob's a little bit as well, it's just what business line you're looking at, right? So if you're looking at hospice or some of the larger deals in home health, you're seeing that the pause, and you're seeing some of that be released. You're seeing some more activity, but some of the core businesses in this industry is very fragmented. Some of the core businesses are still nose to the grindstone, right? They're still getting through all of this stuff, and they haven't come out to market yet. And the question is, does that happen post-Christmas? Does it happen in Q1 or Q2? Does a continued COVID spike in Q1 and Q2, does that continue to dampen some of that? So that's what, I guess that's a question that's unknown. Ben, you're getting ready to say something, but let me announce my next topic. And Brian, you've kind of hit on it, and I'm not sure, we'll open it up to everybody. You know, with these large transactions, what does it mean for the smaller guys, right? So when we talk about these crazy valuations, and we've been at historical highs, guys, for 60 months. So this is not, and you could argue it's been longer than that. But in the last 90 days, those highs are getting pushed up even higher. So what does that mean for the average entrepreneur, average mom and pop? The guy's got a $2 million business, a $5 million business, a $10 million business. What does that mean for valuations? And you alluded to it, Brian. Maybe it's time to come to market. And Ben, you were going to say something as well, but I'll shut up for a second and let you two talk.
Go ahead, Ben.
Well, what I was going to say is, well, you know, obviously those high valuations are a great indicator for the smaller providers out there. Does it translate exactly? You know, absolutely not. You know, you're not going to see the same valuation on a $5 million business that you're going to see on something significantly larger that we're seeing reported in the news today. But it's a good indicator. And again, as I alluded to before, you know, there's so many factors that are involved in evaluation. It's hard to really, you can talk in very general terms, but when it comes down to it, you really need to look at that particular business to understand what the valuation is going to be for them. And again, I can't stress enough, it's always really going to depend on who the buyers are that show up. You know, valuation is very, very buyer dependent. But what I would say, to sort of piggyback off what Brian had said earlier, is, you know, it's a great time to begin to have conversations with buyers if you're thinking about it. And in the end, you know, what do you have to lose? You run a confidential process, you have some conversations, you see what those, you know, valuations look like. If it you know, doesn't line up, if it doesn't meet the expectations, you're no worse for the wear, right? You've had those conversations, you see where things are at. But, you know, during the process, you're always going to continue to run your business as if you're not out to market, as if you're not going to sell, and you're going to do that all the way up until the day you close. So with that, I'll kind of hand it off to Brian to see if he has any follow-up comments.
No, well, I agree. In the words of Stoneridge Partners, esteemed founder Don Cummins, the rising tide lifts all boats, right? So as a result of valuations for larger assets and those high valuations, those smaller assets have increased sort of on the same scale. I will say that one thing that I think is notable and worth talking about is valuations for sort of non-traditional segments, including Medicaid-funded pediatrics, Medicaid-funded personal care, and private pay, non-medical, non-clinical care. We're seeing valuations in those spaces that I haven't seen in years. And I think there's a couple of reasons for that. I mean, Medicaid funded personal care has seen a real growth. There's a reluctance to go to facilities. I mean, who wants to go to a nursing home right now, right? There's an abundance of available staff. And frankly, the states have really stepped up and made those programs more accessible. We've seen rate increases across the board in multiple states who historically have not given rate increases. Now, there are all kinds of threats with that business, just like there always been. You know, intakes and increases in minimum wage. The fact that, you know, the rate increases won't keep pace with that. But at the end of the day, those are growth businesses. I'll say the same about behavioral health. We're seeing buyers enter that market, the IDDD space, who had historically have been Medicare, home health, personal care, and hospice, who also want to add that service, particularly the community-based in-home waiver type services, because it's not tremendously different than really like historical, you know, kind of what you think of as Medicaid-funded personal care. And so we're seeing buyers for that, and that has raised valuations significantly, and the pool of buyers for those businesses, where we would normally have a year or two, maybe even 2 years ago, we would have a half dozen buyers for a large asset in that space. We might have 15 or 20 buyers for an asset in that space now. And I think the same goes for Medicaid-funded personal care in the right states. So pediatrics. There are several folks aggregating that. I think this aggregation strategy and these folks entering the market and the fact that their willingness to invest in a platform doesn't require the same volume that historically has been required by either a strategic or a financial buyer entering into a new market. Historically, that took $10 to $15 million in revenue to really think about, okay, let's enter that market and let's create an aggregation strategy, and we'll adopt a blended multiple, and we'll pick up these smaller providers at bargain prices. We're seeing that. I think that bar has dropped a little. So, $4 to $5 to $6 million in revenue all of a sudden starts to look like, hey, that might be a reason to enter a new market, and that opens up some pool of buyers, and as a result, increases valuation. I think so.
I actually have a question for you guys, Brian. Just listening to you talk about the demand for pediatrics, for behavioral health. One of the trends that we've noticed is a demand for palliative care assets too. Is that something that you're also seeing?
We are. Unfortunately, I don't have a lot of volume, transaction volume to support where the demand is relatively new, and the transaction volume has been relatively low. So I wish I had more empirical evidence to say here's where those valuations are coming out. And Ben, you may have a little more experience with that. You had a deal that had a significant component of that, but we just haven't seen a ton of it yet. So really, for me to feel qualified to say here's where that's coming out. I think there is a demand. I think there will continue to be a demand. But I don't know if I know enough about who those buyers are specifically yet, to be honest with you. So Ben, you might be able to answer.
Well, all I was going to say is I think LHC's recent announcement included East Valley Palliative Care as well.
It did.
Okay, so let's real quick. We're getting 3 or 4 of all of ours in our business. Bob, everybody wants to know what the valuations are, right? So we're getting 3 or 4 questions. I'm going to throw these out, and we'll do our best to answer these. These are not easy questions, but so the first one, and Bob, you're welcome to chime in here, but Ben and Brian, the first question is from Ann. Your experience in private pay for valuations on private pay, non-medical, non-Medicare. And what is our experience in that? Well, yes, we do it. We do a lot of private pay, non-Medicare business. What kind of valuations are we seeing in that area?
I could talk a little bit about that, and then maybe Bob, you might have a better feel for it given some of the announced transactions. Historically, that's been a very fragmented industry, even more so than some of the other sectors we deal with. It's an awfully hard business to scale. I could probably count on one hand pure private pay businesses across the country that I'm familiar with over 15 or 20 million in revenue. And typically those are relatively localized businesses. As a result, the valuations have historically been a little bit low. What we are seeing is we're working through some of those right now. One, an increased interest in those businesses, and 2, increased valuations if there's a little bit of size attached to them. There seem to be a couple of inflection points there. There's sort of growing your business from an owner-operator, 0 to $1.5 million, and then you've got to scale up for continued growth, $1.5 million to $3.5 million in revenue, and then you have to kind of step back, and margins and revenue sort of flattens out, and then sort of going above that, and that $5 to $10 million puts you into a different category. I've been very, very interested in the fact that several buyers who historically have done more regulated services, the Medicare and the Medicaid funded services, have expressed very strong interest in that space now. We're also seeing some equity groups that are building platforms just around private pay. And that I think is something that I just don't know if I've seen for a while yet, unless it was sort of at the franchise level. But if you have an asset that has some size, I think they're seeing opportunity in the fact that there are a lot of these smaller providers out there that can be added on. And I'm starting to see some of those some of these mid-sized providers who are looking for growth strategies, even adopt something I've advocated for a long time as a growth strategy of, hey, you probably know someone down the street who operates a private pay home care business just like yours, only you're larger, and they're barely getting by, right? It's a job, and so they probably would like to come to work for you, and you can add their $1 million worth of revenue without adding a tremendous amount of incremental cost. And that, so that essentially your gross margin drops to the bottom line. You might need another scheduler, you might need another biller, but at the end of the day, that's a really profitable, and where you might sell for 4 or 5 or 6 times, you could probably pick them up for a significantly less multiple. I think that's building real value. And I'm starting to see people really adopt that as a strategy to continue growth and sort of jumpstart their businesses and add on adjacent service areas. So,
Brian, and just to add on to what you said a little bit, we don't have too much insight into the multiples and valuations that we're seeing, but you mentioned aggregators, I think, in an earlier answer. And in the non-medical space, I think is where you see the best examples of the aggregators. You have companies like Honor who have shifted their business model to try to roll up all these smaller agencies to achieve something with scale. You also have, for example, the Amedisys partnership with ClearCare to try to give them more capabilities in that home care space, non-medical home care. But yeah, it's tough. As fragmented as the home health market is with 11,500 or so agencies, home care is even more fragmented. I think that's a trend we're going to continue to see, is these different approaches to achieving scale, whether it's through direct acquisition or through these partnerships or business models like Honor.
I agree. And to your point, and you might have better data on this, but depending on who you ask, there are either 38,000 non-medical home care providers in the US or 83,000, right? I mean, we don't know, right? I mean, some states don't even require licensure. Ben, your home state of Arizona, there is no licensure, right? So, I mean, it's so unregulated. I'm not sure we know how many providers are out there, how big the market really is.
So Chief, Ann gave a follow-up question asking for a specific, valuation, and I'll answer this, but Brian, Ben, feel free to jump in. I mean, that there's a lot of, and the reason we kind of gloss over specific numbers and is there's so many variables that go into whether something's 3 times or 6 times. But you've seen that number on private pay, non-medical, non-Medicare businesses go up, right? So you're seeing things that are hitting 5 and 6 times where historically they were 3 and 4 times. That number's going up. So based on how big you are, your concentration, what city you're in, you can go up that spectrum, right? So part of our job is to get you as high in that spectrum as possible. I can't create the market necessarily, but that market is shifting and it is going up with everybody else. And it's actually creeping into what I would call the Medicaid non-skilled business as well. It's starting to overlap a lot more where it used to be significantly a turn or 2 lower. Ben, Brian, would you all agree with that? You all are a little closer to the ground.
Yeah, I would. And to sort of echo what Brian had said, this isn't going to answer Ann's question, but we have buyers specifically looking for those types of businesses. So the demand is good. That's going to mean valuations are going to go up. But really, I mean, we always want to talk about valuation and we talk about multiples and we talk about ranges because, it's hard to have a conversation like this without giving some sort of numbers in order to try and satisfy people. But in the end, really the only way to hone in on valuation is to evaluate that particular business, to understand its size, its geography, its financial performance. I mean, just so many factors that go into evaluation that it's very, very challenging to have a very generic discussion that would satisfy people and really answer the question.
Yeah, I mean, this year alone, we got transactions in that 5 to 6 range plus. We got transactions in the 2.5 to 4 range in that business line.
I'll just say a quick follow-on comment. That into the private pay non-medical is probably even, I think, one of the most market specific when it comes to valuations. If you're a $5 million agency in the middle of Atlanta with huge growth potential for that sort of high-end clientele, or if you're a large business in Metro DC where there's that top 1/3 of wealth is there, I think, but I think that I think that those command very, very premium valuations because the market growth is there. If you're 5 million in a rural town and in a small area with a finite population and finite demographics, and maybe that a segment of the population can't really afford those services, paying out of pocket, or don't have long-term care insurance, your valuation is going to be a little suppressed. What I will say is that I think people are looking at, and I think this, and I'll go all the way back to Humana acquiring Senior Bridge, which I thought was a visionary move. I think that the payers are starting to see real value in those services and their value in recognizing changes in condition before they become exacerbated and more expensive, before there's a hospitalization, before there's an EMS run, before there's all those additional costs that are a result of a change in condition that the family doesn't see, the doctor doesn't see, but someone who's in the home 8 hours a day is on the ground, boots on the ground, is in a great position to see. And I wouldn't be surprised if you don't see some really savvy providers in that space starting to adopt some risk-based contracts with payers. And I think if you could create something where you shared the risk, there's a model out there, and I don't think anybody's got it right yet. At least I haven't seen it. There's a model out there where you can become a really valuable partner as a private pay or long-term care insurance provider of non-medical home care services, and not be a Medicaid provider and not deal with Medicare. But I think there's some options there that I think will become really, really valuable and increase your value to the market in general, and really create some growth opportunities that haven't been in that market to date, you know.
And then I'll make one last. I'm sorry. Go ahead, then. I didn't mean to cut you off. Go ahead.
Yeah. Well, if you're piggybacking off Brian, go ahead. But I have something on this topic I'd like to add. So.
No, go ahead. Go ahead.
The other thing I just wanted to say is that I think a lot of owners kind of focus on valuation. What is the purchase price? What is the multiple? However you want to address it, but you cannot look at valuation in isolation. You really need to look at the terms of the deal as well, because how much of that is going to be paid cash at close? Is there an earnout, and how much of that is an earnout, and over what period of time is that earnout going to be paid? Is there seller financing, et cetera? So I think, again, you're doing yourself a disservice if you just look at isolation alone. You really need to look at the terms and what those look like. You also need to look at the buyer. Who is the buyer? And what kind of a process you're going to be running as you go through it. But those are just some of the few things that you need to be discussing, or at least thinking about when you're talking about valuation as well.
Yeah. So my last comment on that was going to be, we didn't skipped over it. One of the things on valuations, if you're running at 7%, it's a totally different valuation if you're running at 17%. So we talked about geography and concentration and size. Profitability is obviously a big factor as well. One quick question, and we got about 15 minutes or so, and I want to go through a couple of these questions and hop back on some of the other ones. Multiples post versus pre-COVID. I think we hit on this. I mean, the short answer, and Ben, Brian, speak up if I misspeak this, is historical valuations have held strong, and probably in the last 90 days, because of the lack of supply, have gone up, right? So whatever they were historically going into March, April, they are continuing to be at that level, if not higher. That tick up that's higher, I'm not sure how long that lasts, because those valuation numbers going into March and April were at historical highs for the last 60 months or longer. So we have seen a little bit of a tick up. I don't think you'll say we're in a post-COVID world yet, but post the outbreak, the valuations, everybody kind of thought valuations may come down or fall. They have not in this industry by any stretch of the imagination. Brian, Ben, anything quickly on that topic on valuation?
Well, I think Bob nailed it earlier when he said, buyers understand what they're looking at, and they're willing to discount the COVID, whatever effect COVID had, and look more at an historical and potential. I think they've dealt. Many of them have dealt with the effects of COVID in their own businesses. So I think that those adjustments I think buyers have gotten very good at factoring in those adjustments. And I have not seen even transactions that were underway prior to now they've taken longer because I mean, in a COVID world, it's just diligence is more difficult. It presents its own challenges. So a lot of the transactions that we've closed in sort of this post-COVID or during COVID started well before COVID really had big effects on the business. We've not seen those buyers gone back and ask for significant reductions in purchase price as a result of that. So.
But there's a reason for that too. I mean, those deals wouldn't be getting done if they were looking to impact valuation based upon that COVID, whatever you call it, impact.
Okay. Real quick, a couple other questions, Steve. I just want to, he's asking about valuations and behavioral health. With Bob on, we've kind of focused today on home care and hospice. A big sector of what we do is behavioral health. It's at least a third of the deals that we close, if not more. And I'm going to have some ad hoc speaker series that are nothing but behavioral health. But the short answer is substance abuse, our work in developmental disabilities. Those valuations remain robust and they're going up. We actually saw, we're closing one this week. We closed one last week in the substance abuse MAT clinics. The valuations are going up in that area as well. So they're all 5, 6, 7 times on an EBITDA on a well-run, profitable business. All the same caveats: size, profitability, where they are. I mean, there's all kinds of issues that go into that, but those valuations have done nothing but stay steady or tick up post-COVID or during COVID. I continue to see those continue to go up. We've not seen the problem that other healthcare sectors have had. We've been blessed at Stoneridge with the areas that we've worked in. We just have had growth in our segments. Our providers have had growth, just not have had the problems with some types of healthcare, like outpatient clinics that some of them had to shut down. We just have not seen it in our areas of home care, hospice, and even in our behavioral health with our substance abuse clinics. They've been deemed essential, and people have continued to go, and the clientele have showed up. So it just shows you how big the demand is for our services from the client themselves as well. So we'll be happy to, Steve, we're going to run out of time to talk about that in more detail today, but I'll be happy to hop on the phone with you or get more experts from our team to address that with you. And we're going to have more follow-up speaker series more on that topic. One last question on this before I go back to some of our other topics. Someone asked about, if you're a company that has everything, right? Home health, home care, private duty, how do they look at multiples? Do you value all the companies in its pieces and you add them up? Or is it a blended multiple? What do you typically see your buyers doing? Ben, Brian, how people typically value that?
Yeah, I mean, again, it's probably is not going to be a very, very satisfying answer. I mean, I think it's going to depend. I mean, what percentages are we talking about? Are they spread out equally? Is there one segment that is predominant? And so depending on that, I think that's going to impact the ultimate valuation and how that's looked at. But I would say probably pretty typically, I mean, if you're more spread out, it's probably, Brian may differ. I'd love to get his point of view, but probably be more of a blended sort of look at valuation. Whereas if you have one business line that is more predominant, you're probably going to be looking at that particular business line, and that's going to be probably more impactful on how the valuation is looked at.
Well, I broke my crystal ball on the way to work today, but specifically my hospice one. So because I don't know what the heck's going on in that world, I can tell you that historically, I would have told you that the Medicare home health and the personal care private duty would have fetched dramatic, pretty. There would have been some variance there. I have seen those come together over the last really about year and a half. Those valuations are a lot closer than they've ever been in the past. So I really argue that those two are almost at least they're similar, if not the same. Hospice, on the other hand, really don't have any idea what's going on there. I've set expectations with buyers and been wrong. I will tell you that. But some of the more recent deals announced make me scratch my head a little bit. Obviously, valuations are as good as I've seen them in many years. I don't know how long that lasts. We're talking about some changes that could. There are some changes on the horizon that could. We don't know what's going to happen with value-based care and whether or not that's going to be delayed post-COVID, and some of the carve-ins, what that looks like. I wish I had a better outlook on what that is right now. I will tell you that I think right now they're as good as it's going to get, and maybe as they've ever been, particularly for hospice. But
and
I'll
that
extend that to personal care, private duty, and Medicare home health as well.
Brian, you mentioned the carve-in. That kind of seems like a big topic that we haven't really touched on yet, both for home care and for hospice. They're both increasingly involved in the Medicare Advantage world now too. What we might have thought as private pay home care last year might no longer be just private pay. They might have a little bit of a Medicare Advantage business. And I'm sure that factors into valuations and putting multiples together as well.
It does. I think there's a huge question mark around that, though, and I think it revolves around what sort of regulatory requirements will entail, right?
Yeah.
I mean, are these Medicare Advantage plans going to let? Historically, that's been a relatively loose. Private pay home care has been relatively loosely licensed and regulated. So, are you, as a Medicare Advantage plan, going to? What are you going to require? Are you going to default to? You know what? These people are accredited because they're a Medicare agency. Maybe I'll just give it to them. So are they going to get, is it going to be the boom that these guys think it's going to be, or is it going to layer on some regulatory requirements that they historically haven't had? And with that comes expenses and compliance issues, and who's going to survey them? And will the plans do that? I don't know. I think that's the question mark in my mind, is how valuable will it be if you layer that on top of it, and there's still one managing care and two looking for competitive rates. I think that the best private pay agencies and the largest private pay agencies are the ones who have a care management sort of component. So someone that appeals to trust officers and long-term care insurance companies and has somebody who manages the care, whether it's an official service they offer or not. Well, are those people going to have some certification? If so, are they more expensive? And if they are, does the market support that? If you're 20% higher than everybody else in the market, and you have to be because you provide those services and you have that extra regulatory layer, are you pricing yourself out of the historical, hey, guilty son across the country paying for care for mom market? And if so, what does that do to your revenue, right? So as we phase into this advantage carve-in, so that part I think is a real question mark, Bob. I wish I had a better answer, but I think it just remains to be seen what the requirements are.
So let's. I got a couple. We got about 10 minutes or less. Steve asked about owner. I hate to not ignore these questions. Owner salary, it does get added back in the EBITDA, Steve. That's a different Steven. Although there has to be, so that is a positive add back for EBITDA, although there has to be a negative replacement salary. So if your owner salary is market and you do your job, there probably wouldn't be any net effect. But if you're overpaid as an owner, that gets added back. But you have to. So if you're paying yourself 200 and it would only be 100 for a replacement, there's 100 delta that gets added back. If that makes any sense. Plus any extra benefits that would not be with a manager type. That is an add back. So Bob, real quick, we got about 8-10 minutes on. That's the valuation piece of this. Let's go back to COVID and what's going on. So the pandemic has had a lot of regulatory changes, some of which are temporary and some of which sound to be more permanent. Which ones do you think are permanent? And are there any? And I'm combining a couple of things I told you we talk about. And are there any silver linings in this whole 2020 COVID PDGM blend?
Yeah, definitely. And let me apologize too, because of course they're going to be doing road construction right outside my window while you guys have me on. So hopefully you could bear through that, and we're not picking up too much of it. In terms of things that are going to stick around and things that are going to maybe fall back to normal, you've probably heard this a million times, but telehealth and virtual care is here to stay. I think a lot of the waivers that we're seeing both on a state and federal level will become permanent, not just for public health emergencies, and certain disciplines may be able to deliver virtual care on a permanent basis moving forward. One regulatory change in the home health space that popped up during COVID and will stick around for sure is the ability for non-physicians to certify for home health services. Even at face value, that seems like it would make a huge difference on the operations side for agencies, but there is still the challenge that state law could supersede federal law on what non-physicians are allowed to certify, what they can't certify. So that's not really a huge flexibility in a lot of states. And then on the operations side, I think, we will see a lot of agencies that are still sticking with remote workforces. Maybe don't need as much office space. I think we'll see a lot of agencies sticking to remote hiring and onboarding systems beyond 2020. Going back to silver linings, Rich, I touched on this in one of my earlier answers, but we're seeing a huge demand for hospital at home models and SNF at home models right now. And the interesting thing about both of those models is they require medical and non-medical services at the same time to be effective. And that kind of reflects the overall health system's awareness of preventative care and what home care agencies could actually deliver in terms of positive health outcomes and keeping folks out of the hospital. So that's a trend that's just going to continue as well.
Well, as you talk about that, Bob, I think that's an interesting point, and I think you're really well qualified to talk about this. But historically, at least my experience has been, even companies that offer multiple legs of the stool have very little coordination between the clinical portion of Medicare home health and the assistance with activities of daily living, of private duty Medicaid personal care. I mean, do you see that? I mean, it feels like they're going to be forced to coordinate that and bring in a medical component to that. Do you think that you'll see health systems I mean, for years, way back, health systems didn't want home care, hence all these joint ventures, right? We can't run it. We don't know how to do it. You come in, you run it, take care of it. Will that trend reverse, do you think? Or do you think that they'll want to be that portion so that they can manage that piece of it? And if so, will it go as far as the non-medical portion, and so that somebody manages that care throughout the spectrum there?
Yeah. When we're looking at home-based care organizations in a Medicis or a Beata, for example, I think we're seeing them internally break down silos across their different departments. When they have a patient, they'll get everybody together on a meeting to talk about what's best for that patient moving forward, and not really just have one discipline dictate what needs to happen. It's a team effort. To the point of health systems offloading some of their home health or home care needs, I think we see that continue just because it's getting way more complicated to do home health and home care at an expert level, especially home health care with PDGM and some of the other regulatory challenges that we're seeing. Hospitals and health systems have their own problems. I think they're looking for companies who specialize in this. So yeah, I expect that JV strategy to continue for the foreseeable future.
What's interesting,
Guys,
so you're in your conversations, you're hearing that folks there's a recognition, at least, that the medical and non-medical portion of their businesses need to talk to each other, because historically, I just don't think it's worked that way. I mean, even companies that I've been involved with really weren't that good at it. I mean, let's face it. So good. That's I think that's an important way for that to work. And really, all three legs of the stool should. It's what the patients want, and it's what the payers want, right?
Yeah.
And it'll drive down costs in the system overall. Hey guys, we have about 1 minute left. So any final comments, Bob, Ben, Brian?
I guess the final comment that I'll just echo, Brian, earlier, you said that PDGM hasn't been as bad for the home health business as maybe some people thought. And we've seen that on home healthcare news too. I think I've personally been surprised in a good way how many from small mom and pops to large organizations have succeeded under PDGM. I think a lot of people will tell you that the model still is flawed, that a lot of the assumptions CMS had with the behavioral adjustment are off, and that it needs to be tweaked a little bit. Hopefully that'll happen for 2022. It's not going to happen for 2021, but yeah, PDGM wasn't the boogeyman a lot of people thought it would be.
Well, I think it's a testament to the resilience of the industry too. I mean, to your point, I mean, it was, and a recognition that the service is needed and necessary. So,
Ben, anything final for you, sir?
The only thing I'd say is, some of the conversations, there were a lot of conversations around valuation and what things look like for particular business lines or industries or organizations. And all I would say is that really the best way to kind of figure that out is to actually just have a confidential call with an expert who really understands the market, so they can kind of dig into your business and give you a really accurate understanding of what that valuation would look like.
Okay, guys, thank you for the three of you joining us, and then thanks for all the participants for joining us as well. We will have another one of these in February, and then we are also going to have some ad hoc ones specifically on some topics, much shorter speaker series, but please join us for going forward. You'll continue to see announcements. I will talk to you soon. Thank you, guys.
Thanks, Rich.
thanks, Rich. Thanks, Bob. Ben,
Thanks,
see you
guys.
later.
Thanks, guys. Take care.